One of the main factors that affect the value of the US dollar is the interest rate set by the Federal Reserve, the central bank of the United States. The interest rate is the cost of borrowing money, and it influences how much people and businesses are willing to spend and invest. When the Fed raises the interest rate, it makes borrowing more expensive and saving more attractive. This has several effects on the demand for the dollar and its exchange rate with other currencies. First, a higher interest rate attracts foreign investors who are looking for higher returns on their money. They sell their local currencies and buy US dollars to invest in US assets, such as treasury bonds, stocks, and real estate. This increases the demand for the dollar and makes it stronger against other currencies. For example, if the Fed raises the interest rate from 0.75% to 1%, an investor who has 100 euros can get more dollars for their euros and earn more interest by investing in US bonds. This makes the dollar more appealing than the euro. Second, a higher interest rate reduces the demand for imports and increases the demand for exports. When the dollar is stronger, it means that foreign goods and services are more expensive for Americans, while US goods and services are cheaper for foreigners. This discourages Americans from buying imports and encourages foreigners to buy exports. This reduces the amount of dollars that Americans spend abroad and increases the amount of dollars that foreigners spend in the US. This also increases the demand for the dollar and makes it stronger against other currencies. For example, if the Fed raises the interest rate from 0.75% to 1%, a car that costs 20,000 euros in Germany will cost more dollars for an American buyer, while a car that costs $25,000 in the US will cost less euros for a German buyer. This makes the US car more competitive than the German car. Third, a higher interest rate affects inflation and economic growth. Inflation is the general increase in prices over time, which reduces the purchasing power of money. Economic growth is the increase in production and income over time, which increases the standard of living. When the Fed raises the interest rate, it usually does so to combat inflation and slow down economic growth. This is because a higher interest rate reduces spending and investment, which lowers demand and prices. This also lowers output and income, which slows down economic growth. A lower inflation rate and a slower economic growth rate make the dollar more stable and reliable than other currencies that have higher inflation and faster growth. For example, if the Fed raises the interest rate from 0.75% to 1%, consumers and businesses will spend less on goods and services, which will lower their prices and profits. This will also lower their income and production, which will slow down economic growth. In summary, rising US interest rates increase the demand for the dollar and make it stronger against other currencies by attracting foreign investors, reducing imports and increasing exports, and lowering inflation and economic growth. How a stronger dollar hurts emerging markets by making their debt more expensive and reducing their competitiveness. The US dollar is the world's reserve currency, meaning that many countries and businesses use it for international trade and financial transactions. When the US dollar becomes stronger, it means that it can buy more of other currencies, and vice versa. This has important implications for emerging markets, which are developing countries that have high growth potential but also face various economic and political challenges. One of the main problems that a stronger dollar causes for emerging markets is that it makes their debt more expensive. Many emerging markets have borrowed money in US dollars to finance their development, such as building infrastructure, expanding industries, or importing goods. When the dollar appreciates, it means that they have to pay back more in their local currency, which reduces their purchasing power and increases their debt burden. For example, If a country owes $100 million and its currency depreciates by 10% against the dollar, it now owes $110 million in local currency terms. This can lead to difficulties in servicing the debt, especially if the country's income or exports are also affected by the stronger dollar. Another problem that a stronger dollar poses for emerging markets is that it reduces their competitiveness in global markets. A stronger dollar makes U.S. goods and services cheaper for foreign buyers, while making foreign goods and services more expensive for U.S. buyers. This means that emerging markets face more competition from U.S. producers and less demand from U.S. consumers. This can hurt their export revenues and growth prospects, especially if they rely on exporting commodities or manufactured goods that are easily substitutable by U.S. products. For example, if a country exports oil and the dollar rises by 10%, it means that its oil becomes 10% more expensive for U.S. buyers, who may switch to cheaper alternatives or reduce their consumption. Therefore, a stronger dollar can have negative effects on emerging markets by making their debt more expensive and reducing their competitiveness. This can lower their output, consumption, investment, and government spending, and increase their risk of default or financial crisis. A weaker dollar, on the other hand, can have positive effects on emerging markets by making their debt cheaper and boosting their competitiveness. This can raise their income, demand, growth, and stability.